So since the beginning of the year, GME has gone from less than $20 a share to above $150 a share, and we're talking in less than 30 days. What is going on with this stock? What's pushing it up and down? And more importantly, how can we take advantage of this as option traders? Well, that's going to be the focus of today's video. So let's get started. Hey everyone, Tom Gentile. Welcome to Tom's Trading Room, sponsored by Optionetics. Check out the free reports as well as a free trial to my software at Tom's Option Tools just by simply going below and checking out the description below this video. Also, you know the drill. Like this video, it helps support the channel, and subscribe, and you'll get videos like this instantly as soon as they are uploaded. So let's not waste any more time. Let's get started. I want to talk about really what's going on with GME, GameStop. More importantly, can we take advantage of this as bullish, bearish, or neutral traders? Well, let's find out. Okay, so let's first set the table. This was before the market even opened, and this was in pre-market, where if you were up this morning, you would have seen that GameStop jumps another 50% to 100 at one point. Trading briefly halted in another wild day. Yahoo Finance says pretty much the same thing. From there, however, things got even on more of a wild ride. This was a shot from the intraday prices today as GameStop hits a high of nearly $160 a share, $159.18, before coming back down. But you can see the move. I mean, this high represents more than a double from Friday's closing price, which was around 65. I mean, you get to 110, that's a double there. You can see that's quite a bit higher. I mean, we were nearing triple category on a stock for one day. Now, the next thing I want to look at is, well, what are the options trading for? Now, this was a snapshot of this morning's options, and what I have highlighted at the time were the at-the-money calls and puts. The at-the-money calls being the 90 calls, and of course the 90 puts were what I grabbed as well. Look at this. This is 1 week to expiration. These 90 calls were trading for $23.45. The puts, $25.75, and it just shows you how much volatility is in this market. Now, to give you a comparison, where's the VIX trading at? 15-ish, all right? 15, that's the volatility for the overall stock market, or the stocks in the S&P 500. The volatility for GameStop coming into this morning was 641 for the calls, for those 90 calls, and 696 for the puts. It gives you a comparison. 15 for the stocks in the S&P 500. 600 to 700 for GameStop's options. So you can see that even the option traders have no idea where this is going from moment to moment. And what's causing this move? Well, you don't have to go much farther than social media. You take a look at Reddit, Robinhood, TikTok. All these trading groups are gunning the hedge funds right now. They are, in fact, you can see here, GameStop hit stock record high after Reddit-backed short squeeze. So campaigns by YouTube, TikTok investment accounts, and they're all talking to each other on social media saying, let's get these guys. Buy it, whatever price, buy it. And the same thing's happening over with Robinhood. And so we're seeing small social groups banding together that push these stocks that have these small floats, number one, and number two, large short positions. All right, large short positions. We saw there was over 100% short position leverage on GameStop last week. And these guys know it, and they're trying to take it to their advantage to squeeze these hedge fund traders to admit they're wrong and buy back the stock, even further causing it to move higher. And that's what's going on today. So as an option trader, I look at this and I look at all that option data that I see going on and all this high volatility. And I say to myself, how do I play this as an option trader? Now, this was a difficult one because this stock nearly tripled in one day. So it doesn't matter how far out of the money you go, you're likely to get hit. So the best way that I can think of to try to play this is on a one-to-one basis. Create a fixed reward and a fixed risk that you're willing to risk losing. Right? Now, you could do that with a call option, but the problem is these are just too expensive. So I'm looking at selling high volatility. All right, so there's three ways I'm looking to play the volatility. Sell, sell, sell. And I mean, don't sell the stock. I mean, sell the option premium. If you're bullish, you look at selling put spreads. If you're bearish, you look at selling call spreads. And if you're neutral, why not sell both? Now, these are called credit spreads, so let's quickly review what a credit spread is. A credit spread occurs when you sell a higher priced call or put and protect it by purchasing a lower priced option of the same type. So if you're bullish, you would look at selling the higher strike put and buying the lower strike put. And the lower strike put is protection. That allows you to sell those puts and have a limitation of what you're willing to risk on the trade. Same thing with calls. To set up a bearish trade with calls, you would sell the lower strike call and you'd buy the higher strike call for protection. The net result would be a credit to your account. Now, let's look at some examples using what's happening with GameStop as of today. So this was off of this morning's trading action. But if I were looking at something that was near the money, very close to where the stock's trading at right now, and I wanted to create a bullish scenario, this is a bullish put spread where we would be selling the 85 puts, and this is a 1 week trade. So if I were to sell the weekly options and sell, again, that higher strike put and buy the lower strike put for protection, at the time that I snapshot this was giving a credit of $312 right up the middle to risk $188. Now remember, where do you get your risk at? You take the difference between strikes. This is a 5-point spread, and you back out how much credit you receive. And what's left over is your risk. So in this case, you could be bringing in $312 and risking only $188. That's how lopsided the option prices are right now with this particular underlying issue. So that's a credit spread. What's it look like on a risk graph? Well, it would look something like this. We would take a look at, how would something like this look? Well, it would look like this. We would take a look at the actual graph itself. And the graph itself is very interesting because if we stay above this area somewhere near 82, all right, that's your break even by the end of the week. Anything above 82 is profit. Anything below 82 is loss. And the reason why is, remember, we're dealing with a credit spread where we're taking in over 3 points on a 5-point spread. All right, if we go below 80, we can lose no more than the difference between strikes minus what we brought into the trade. Now, if you're bearish, if you think that GameStop has run its course and you want to take advantage of the other side, a bearish call example would look like this. We would be, again, selling those lower strike calls and buying the higher strike calls for protection. And in this case, it looked actually a little bit different. The reward, the credit you're bringing in, was much less than the maximum risk that was available. Again, 5 points between the what you're selling and what you're buying. You take that 135 minus 5, and that gives you your maximum risk of $365, and this is on a per spread basis. All right, so again, this example used selling the 90 calls and buying the 95s, again, using a 1 week option. What does it look like on a risk graph? Well, it looks like this. If GameStop drops lower, all right, if it stays you take a look at the break even, it's $91.35. So as long as we are at or below that $91.35, this makes money. If we're above $91.35 by the end of this week, then this trade would lose money in value. It could lose no more than that 5 points. So if it was above 95, doesn't matter if it's at 95 or 195, you're only out for the difference between the strikes, which is 5 points minus the credit you brought in. Now, what if you wanted to take a neutral example? You weren't bullish, you weren't bearish, but you wanted to put a trade on that worked if it stayed right where it is, or it ends up right where it is by the end of the week. Well, a neutral example would be doing a combination of both. So the example I want to show you is the first two trades once again. But what we did was combine them. So you could take the 80-85 put spread, selling the 85, buying the 80. And you could take the 90-95 call spread, and you would be selling the 90, buying the 95. And what you've done is you merge this together to create what's called an iron butterfly. An iron butterfly is the combination of this at the money put spread and at the money call spread. These are actually slightly out of the money. When you look at it on a risk graph, well, first of all, take a look at the trade. It's so lopsided right now that you see a $447 credit and only a $53 risk. All right? So, but there's a lot of volatility going on here. So the chances of actually getting that is slim. The best way to put yourself in position to do that is if you did like a trade like this, then you would put it on and you would look at a limit order for what you want to bring in as a credit. This actually looks like a fantastic trade, but again, with GameStop moving all over the place, this is resetting itself moment by moment. But let's say we could get this example and we could get this trade off at this price. Then your risk graph would look like this. This is the risk on the trade. The risk on the trade is, and let's go look at the downside, upside, downside break evens. Right? Downside is 80.53. Upside is 94.47. So the only way this loses money is if we're above 94.47 by expiration Friday, or we're below that other price, which was $80.53. If we're in the middle, if we're in between those, then we stand to make a profit. And if we're between 85 and 90, what happens if on Friday's expiration we're between 85 and 90 and GameStop closes in between? Well, guess what? All of this goes to zero and we keep the credit that was received. So that is how we put together 3 different trades, all based on selling this extremely high volatility and creating a situation where you have a fixed risk and a fixed reward. In summary, with high volatility comes high risk as seen in GME, especially for stock traders. But option traders have a way of placing these orders, and by doing them properly, you could fix the amount of risk and reward that you can have on the trade. These prices can bounce around fast, so I use limit orders to get into high volatility assets like this. And while nothing's a guarantee, I like the fixed risk and reward that these types of spreads offer because, in my mind, they are much less risky than either buying or shorting this stock. Hey, thanks again for joining me. I hope you found this video educational. If you did, hit the like button below. Again, subscribe to our videos. You'll get them instantly as soon as they are uploaded. And I'll see you again later in the week. Bye now.